Good morning, Alexandre.
Good morning, Anna.
Welcome to our studio. You are our Global Chief Investment Officer here at Indosuez. In your recent editorial for the Housley Month View, you talked about the recent Artemis mission to the moon. And I think we all saw from that how small and fragile the Earth looks from space. That comes at a time when our energy and economic security depend on an also tiny bit of territory, the Straits of Hormuz. Europe then has experienced an unprecedented energy shock, which has called into context your macroeconomic forecasts. What macro revisions have you done, and what is your forecast equilibrium price for oil?
So first of all, as far as oil is concerned, we forecast oil prices to remain elevated in the second quarter, up to about $100 a barrel, and progressively move to a new equilibrium at around $80 a barrel, which is still significantly higher prior to the shock where oil prices were around $60. In that respect, we have changed some macro assumptions. In the US, I would say those revisions are marginal. The US economy continues to be resilient. We still have 2.4% growth this year, which is above potential. Inflation, yes, there will be a shock this year and probably go above 3%, but then should return towards 2.2%. There are still some deflationary forces out in the US. In Europe, it's a different situation. We're going to take, first of all, an immediate shock of oil now, and then we'll take a second shock from natural gas prices in the next winter. So here, the revisions of growth are much larger. We expect growth to be less than 1% this year, and again 1% last year. So effectively, out of the last 2 years, we are going to lose the benefit from the German infrastructure plan. And then inflation is going to be a bit more persistent, probably around 3.3% next year, and should still remain well above the ECB target next year.
Well, turning to ECB monetary policy, we have the ECB meeting this week. The market is expecting 2 hikes for 2026. Your view is that rates should remain unchanged. Can you explain this divergence in views?
Yeah, we have a very different view here. I think the question is, can the ECB raise rates? The answer is certainly they could, for sure. That's the mandate, by the way, fighting inflation. Our view is different. We think they should not raise rates. I mean, this is a different situation compared to 2022. It's a supply shock. It's not a demand shock. There are some still deflationary forces. There is no inflation from services, lesser inflation coming from salaries in particular. So the ECB should look through this short-term shock and take the view that inflation expectations remain anchored, and as a result, progressively, inflation will return to its target next year. So in our view, at a time where Europe needs to invest a lot and where we're going to take a big economic shock, it would be, in our view, a policy mistake to raise rates.
Well, turning now to equity markets, we saw in the US that equity markets had a historic rebound of almost 10% in as many days after the tricky start to March and April due to the war in Iran. The House view is to be constructive on equities for this year. Why, in your view, should investors remain optimistic still on equity markets?
So our mantra since the beginning of this conflict was stay invested, don't panic. Since 1950, there has been 20 episodes of a rebound of 10% in 10 days. On average, the 1-year forward return in those 20 episodes is around 20%. So there are still reasons to be optimistic in our view, even after the rebound. But most importantly, is this time round, we have seen actually an upgrade in earnings expectations, which are very important. Usually in a stagflationary shock, you tend to have revisions lower of earning expectation. It's not the case here. We're talking US going from 15 to 20% earnings growth for 2026 at a time where elevations are much more affordable. The last point as well, where we are quite optimistic here, is that as much as before the war, there were a lot of doubts about artificial intelligence and the capacity to monetize the huge capex that is taking place, there is more and more evidence now that some companies are able to monetize and to be more profitable than we expected. But then we make a differentiation in our positive view. We are very positive in the US. We are still very constructive as well on emerging markets because this is another pocket of growth around artificial intelligence. But inversely, we tend now to be a lot more cautious on Europe as a result of what we just mentioned.
Talking briefly about strategic autonomy, The current energy shock highlights once again Europe's vulnerability. I think the head of the International Energy Agency has gone so far as to say that what we're living through has triggered the greatest global energy security threat in history. So what began at the Paris agreements as an environmental necessity has now become an economic one. In your view, is this a new structural theme, and how should it be approached from an investment perspective?
Yes, absolutely. If there is one lesson coming from this conflict in the Middle East, and if we look through this shock, is that a lot of countries realize their external vulnerabilities. That is on energy at large, whether it's fossil fuel, whether it's natural gas, it's on critical minerals as well, it's on precious metals, it's on industrial metals as well. So I think that going forward, the strategic autonomy, which in the past used to be around artificial intelligence, defense, which is going through some air pocket, but on which we are very, very optimistic, is everything linked to natural resources is going to become a dominant theme for the rest of the year.
Well, thank you very much, Alexandre, for your insightful analysis on what's quite a challenging time at the moment. If you would like to find out more about this interview or any other interviews from our other experts, please look at our latest monthly House View.